We are very interested in tracking and understanding the formation of trends. And in order to understand the formation of trends, it's important to understand cycles. We'll talk now about market cycles. Market cycles 101. Here's the important thing to understand when it comes to market cycles and trends is that cycles are not unusual. When you hear about market cycles or you hear about trends, it's not the same thing as hearing about horoscopes or other kinds of funny, superstitious kinds of ideas. Cycles are real. Cycles and trends are real. Cycles are everywhere in nature. Everything in nature, in fact, moves according to a cycle. In fact, here is some ancient wisdom from the great King Solomon from the book of Ecclesiastes. If you've never read the book of Ecclesiastes, even those of you who are not Bible fans, you would really do yourself a favor by picking up the Bible and reading the book of Ecclesiastes. It is probably one of the most intense and unusual books that I've ever read. Ecclesiastes, powerful insights from the King Solomon. Well, anyway, here is a little snippet from the very first chapter of that book. And listen to the wisdom, where he says, King Solomon says, "The eye is not satisfied with seeing, nor is the ear filled with hearing. That which has been is that which shall be, and that which has been done is that which will be done. So there is nothing new under the sun." Right? Nothing new under the sun. Is there anything of which one might say, "See this, it is new"? Already it has existed for ages, which were before us. There is no remembrance of earlier things, and also the later things which will occur, there will be no remembrance for them among those who will come later still. In essence, what Solomon is saying is that, and if you go back even earlier in this chapter, he's saying that the rivers flow into the sea, and the seasons change, and everything just kind of continues, but nothing is new, right? Nothing is new. That which has been is that which shall be. That which has been done is that which shall be done. There is no new thing under the sun. Again, giving us more information that we are living in a cyclical nature, right? Nature is cyclical, and that we are cyclical beings even ourselves. Let's just go on and take a look at this. There are planetary cycles. There are orbital patterns, weather cycles, ocean tides, animal migration. All of these things move according to patterns, and they move according to cycles. And so, therefore, scientists study these cycles. They can study the orbital patterns. They can study the weather cycles, right? They can study how the ocean tides ebb and flow. They can study how animals migrate every time at this particular year, right? The world moves according to cycles. Then you have organic cycles, not planetary. Let's talk about organic now. This is more on the earth, right? Not up in the heavens, but on the earth. You have the water cycle. Those of you who are heavy into geology or heavy into earth sciences, you know all these cycles. The water cycle, the sedimentary cycle, the nitrogen cycle, the carbon cycle. These are all the geochemical cycles that we learn about in nature. The sleep cycle even, right? That is even a cycle that we see. The agricultural cycle, right? The bioelectric rhythms, right? The circadian rhythm in your body, the 24-hour rhythm, brain waves. All of these things are cycles, right? Repeating patterns, repeating cycles. Then you have, in physics, you have cycles. You have the Fibonacci sequence. We're going to talk about Fibonacci in an upcoming training session, because the Fibonacci sequence is actually a sequence that is very popular in mathematics. It was discovered by an Italian mathematician. And the Fibonacci sequence is a very interesting, and in fact, when you take the numbers and you look at the sequence, and then you look at the squares, you end up with the golden mean or the golden ratio, which is all just very, very interesting stuff. But we're not going to go there now. Just realize that the Fibonacci sequence of 0, 1, 1, 2, 3, and these numbers are literally made by adding the number before it. So you have 0, and then you have the next number is 1, so then you add the two together and you have 1. And then you take the last two numbers together, 1 plus 1, and then you get 2. And then if you take 2 and you add it to number 1, you get 3. So basically the Fibonacci sequence is a string of numbers that is created by taking the last two numbers and adding them together to create that. And then the last two numbers, adding them up to create that. And if you do any research on the Fibonacci sequence, you'll discover that it creates some stunning, stunning patterns in nature, right? The Fibonacci sequence appears all throughout nature. It appears in our galaxy. It appears in seashells. It appears everywhere. The Fibonacci sequence, very interesting. Light waves, sound waves. These are all waves. These are all patterns that are occurring and repeating over and over again. So we're surrounded by this. Then, of course, you come to the world of business, right? So we talked about organic cycles. We talked about planetary cycles now. We've talked about even physics cycles. But those cycles don't stop there. They move everywhere, all across humanity, all across what we do. There are economic cycles. There are market cycles. And, of course, we wonder why do we see this? Well, because the markets are driven by human beings, right? Human beings are cyclical beings, right? Men, many people don't know this, but men have a monthly hormone cycle just like women, right? Women have a monthly hormone cycle. We all know that, right? Men, but men also have our own monthly hormone cycle, right? And maybe women know about that too. Maybe we don't know about it. But the point is that we all have cycles, right? We have the 24-hour circadian rhythm, right? That literally drives every single living being on the earth. So when we think about all of that, and you realize that we ourselves are driven according to cycles, the financial markets, it should not be surprising that they move according to a rhythmic cycle because they are driven and controlled by people like you and me who are cyclical in nature. So we bring our cyclical nature to the market whenever we show up. We are emotional human actors that show up and bring our cycles. Our cyclical being comes to the market, and we create cycles in the market. Okay, so the market does not create cycles. You and I create cycles by our participation in the markets. The markets are driven and controlled by human actors. And because they're driven by human actors, they're driven by cyclical actors. And not only are those actors cyclical, but they're also driven by what? They're driven by emotion. Okay, so this is why emotion becomes one of the most important things for you to get under control in order to be a good trader. And this is why Wall Street is leveraging high-frequency trading and other types of systems to permit it to be able to exploit the market and the cycles in the market without giving in to the cycle itself, right? Now, this cycle can be summed up really well with an image like this. This is the cycle of market emotions. And you could really kind of make one of these on your own. You could just kind of come up with different words. But you can really think about this as a cycle in the market moves. Let's say this is the cycle of the stock market. Let's say this is the bubble. This is the bursting of the bubble. This is the new downtrend. This is where we find support, and then we start to come back up, right? This can play out over the course of a 1 hour time frame, right? This entire cycle. It could play out over the course of 1 day. This whole cycle can play out over the course of 1 week or 1 month or 1 year or 10 years, and literally the list goes on and on and on. I mean, there's just this whole cycle, it repeats over and over and over and over and over again. Friends, there is a cycle to the market, but there's also emotions attached to the cycle. So at the very beginning, whenever you're moving into an uptrend, there is optimism, right? There's optimism. And then it moves into excitement, thrill, euphoria. You can fill in the words you want to use. You get the drift. You get the emotional drift. And what's so interesting about human nature is that at the moment of peak euphoria, you also are at the point of maximum financial risk, right? That's the kicker. That's the catch-22, so to speak. At the moment that everybody thinks they are smart, right? You're at the point of maximum financial risk. Okay, so after that, after the bubble begins to burst, you get to the anxiety phase, right? Anxiety. Now, well, is it going to go back up, or I need to sell? And then you go down a little lower, and now you're in the denial phase, right? well, it's just a temporary setback. After all, I'm a long-term investor, right, is what we might tell ourselves. And it just keeps going down. And then we say, well, we're kind of getting scared now, right? It's not really working out. And then we're starting to get a little desperate here. Okay, now we're going to start to panic down here. And then we're going to capitulate here, meaning that we're going to go ahead and sell, right? We're going to sell down here at the point of maximum financial opportunity. This is exactly what Wall Street does. This is why the average, there was a study put out, and I don't have the actual study right here with me, but I will try to reference it and bring it to you. It's a study done by Dalbar, D-A-L-B-A-R. You can look it up. It's a real powerful study that shows that people who invest in the stock market consistently get less returns than the stock market provides. So when you look at the stock market and you see that it provided, you look at a stock and say, wow, it's gone up 10,000% over the last 20 years. Wow, that must be amazing. Well, what you'll discover is that, yeah, you do have people who have participated in that, right? But the majority of them have bought here and sold here during that rally, right? All along the way. And so the cycle of market emotions is something that it's very important for you to understand. And we're going to talk about emotions later in some future trainings and how to control them, how to control these emotions. Because to be totally frank with you, the way to win in trading is to not have any emotions, right? To not have any, and basically to not be human. The only way to succeed in trading long term is to detach the emotion from it, because the cycles exist, but the cycles will invoke emotion in you. And that's where people lose, because they're cyclical and because they come to a market that's driven by cycles, they are also driven by emotions. It's a catch-22. You understand the cycle, but you're still driven by emotions. Again, this is why Wall Street has high-frequency trading machines and robots that are trading based upon the cycle and not based upon anything else, right? Not based upon gut, not based upon instinct, not based upon anything else but just straight up data. And so the high frequency trader has no emotion, right? It's just literally a bunch of math, and they're looking for the cycle. Okay, so anyway, just to round this out here, we move from despondency at the point of maximum financial opportunity down here. Then we start coming up depression, hope, relief, and there's your optimism again here, right? And so this cycle exists throughout the market, right? You could look at it right here as well. You could see, over time, you get right here, you get to the peak, the greatest potential risk, and you have the highest level of emotion, optimism, and elation. And then, of course, this begins. And then typically this is where people will sell, because they say, well, I was wrong, right? And they go way down here and they sell. And then, of course, they reevaluate and enter back up here again, right? It's the same cycle over and over and over, driving us to buy at the worst times and to sell at the worst times. This picture even kind of shows it a little better, where you can see that this area up here, using your charts, you can see how it runs up here. It begins to peak. This is exactly where the S&P looks like it's at right now, doesn't it? It looks like it's at a peak of euphoria, not quite euphoria, but we're kind of at this anxiety phase, right? We kind of passed that. It's almost like we're down here now on the S&P 500. 2134 as of this recording has been the peak on the S&P 500, and we've been fighting to retake that. So it's almost as if we passed that and we're now kind of here, right, in the anxiety area. If it continues going down, we might get some denial. Then it'll give into fear, and then desperation, and then panic, and then capitulation, and then everybody sells, right? So who do they sell to? They sell to the high-frequency trader. They sell to the Wall Street banks. They sell to the people who say, uh-oh, there's blood in the streets, let's go buy. And then the whole process starts over again. So let's just play this out in real time. Let's actually see this actually applied. And you can see that this right here is the 1929 stock market crash and recovery. So here you have the 1920s. This begins at January 1925. And you have this nice run that really begins. Now look, the Dow Jones is just trading at around 100 during this time. And so it goes from about 125 here at the very beginning of January of 25, all the way up to about 150 by January 1927. This area right here was a time when people were really getting interested in the market, and some really smart people took positions right here, right? Because next we move into this amazing run that has pullback, but just talking about straight up here, right? And then you get a little bit of a pullback here, and then you get the awesome blow-off rally right here. Then the peak is in, right? Here's the euphoria. That's the euphoria. And then it comes right back down as quick as it went up. In fact, it just goes straight down, right? And this right here is the Great Depression. This right here is the Black Tuesday. This is the day that the market crashes. This is the October 1929 era right here. It's followed by what? It's followed by a sucker rally. A sucker rally always comes right after the big sell-off. And so people jump back in and said, oh, it's going back up. We got to get back in. Oh, not so fast. Then it comes right back down. Sucker rally, back down. Sucker rally, back down. Sucker rally, back down. Sucker rally, back down. Remember, in a bear market, you get fast and furious sucker rallies followed by sharper volume downtrends, right? So this right here is clearly in a downtrend. So anybody who believed these breakouts just got shattered. And so anyway, it continues to go down and finally bottoms out in 1932. That's the bottom. So it took 1929 to about 1932 before everything, the downtrend really kind of finished. Typical cycles last about 4 years. Typical cycles last about 4 years when you look at the actual business cycle, so to speak. But that, of course, is not the same as a market cycle. We'll talk about some more in a minute. But anyway, we see that it comes back up and it begins to fight, and we see that it really has support here. You can see that it comes back and tests support here at 100 several times before it finally breaks out and begins to go back up again. And then it repeats the whole process again, right? It repeats the whole process again. Here we have a more close-up look of the 1929 stock market crash and recovery. And here you can see how that crash, lasted for a period of 2 months, followed by the after-crash recovery. This is where people thought, oh, maybe things are getting better. And then, of course, no. We move right back into the downtrend again. So you can see how epic that crash was after the euphoria. Big time. We're going to see things like this again in our lifetimes, right? We're going to see things like this again. These things are not anomalies. These are part of the system. The boom-bust cycle that we live in today is generated by the Federal Reserve. And so it's not as if we can simply just remove these from the equation. We do have to deal with crashes like this that are actually generated, actually manufactured by the Federal Reserve. Whether their intent is evil or not is not my point. My point is not that. My point is that they literally do manufacture these boom-bust cycles. I mean, it's all documented. So you have to be prepared for them. You have to understand that they are going to come. Here's another chart here showing you the length and depth and breadth of the Great Depression. Really just hard here. And then you see this big volume come in right here. That kind of begins to lift the market here, as you can see. Here's another crash from 1973, 1974. Same thing. This one kind of plays out similarly. Really begins a sharp decline here, going from about 1,000 on the Dow Jones all the way down to about 575. I mean, this was a massive drop from 73, 74. Back at the time of the Yom Kippur War, OPEC, and there were all kinds of issues, oil crisis and all this. This was a bad time. Market got real scared, and we saw a real big sell-off here, followed by a rebound. Here's 1987, stock market crash. You can see here, same thing, sharp correction in one day, 22%. I remember that day, 22% down. It was a shocking day. That was one of the first months that Alan Greenspan had come into office. That was his welcome to the Federal Reserve. But that was a big day. It took 11 months to completely recover out of that one. Okay, so let me show you something here. This is the market cycle model, and I think I'll close with this slide here. I just want to bring this now to a conclusion. But let me show you this, because this market cycle model is really what you are using whenever you're trading with Trigger Trade Pro, or whenever you're trend trading in general, right? So here we have, in the green, we have this primary trend, okay? Let's call it the long-term trend, okay? So this is the long-term trend. And you can see the long-term trend is like the Titanic, right? When it goes in a certain direction, it's going to take a while for it to turn around, right? And then it finally turns around, and then it finally begins to come back down, right? All the way down. This is your long-term trend. This one doesn't change every day, right? It moves in a cycle. Okay, so here's your long-term trend, okay? It's the primary trend. This one can last 9 months to 2 years, maybe even longer, sometimes even 4 years. Now, overlapping this long-term trend, you have a weekly trend, right? You have a position trend, right? We call this the position trend. Others call it an intermediate trend. The short-term trend, some would call it a short-term trend. Some would call it something else. We call it the swing trend, okay? And then down here, primary trend, let's just call that long-term trend, okay? These are 3 trends. 3 market trends, market cycle model. Okay, so you have the long-term trend here that is driving everything. That is the overall trend. It's the primary trend. But then you have the intermediate, or the position trend. And the position trend moves a lot more than the long-term trend does, but it moves in the overall same general direction of the long-term trend. But notice what it does. It goes below it, and it goes above it, right? And it goes below it, and it goes above it. So when's the best time to buy the position trend? Well, the best time to buy the position trend in a long-term uptrend is whenever the position trend forms a new uptrend, right? Right here, as it's coming back up. And then it may have a sell signal. But again, if you're in an uptrend and you short a position trend that's going down, you got to realize that that may have a floor, because it won't go down forever, right? Because there is an uptrend in place. So therefore, it's going to eventually move back along with the primary trend. Okay, so that's the position trend. Now, finally, let's talk about the swing trend. The swing trend is this little red trend here that is moving around. And it moves around what? It moves around the position trend, right? Just like the position trend runs around the long-term trend, this swing trend is just running all around the position trend. So when is the best time to buy the swing trend? The best time to buy the swing trend is whenever it pulls back below the position trend, right, and then comes back up, right? So as it plays and intermingles with the position trend, it's doing it just as the position trend intermingles with the long-term trend. So understanding the market with this picture is very powerful. This is actually what you're doing as a trader. You are taking advantage of trends, and you're choosing the trend that you're going to trade. Are you going to trade the long-term trend? Are you going to trade the position trend? Or are you going to trade the swing trend? And knowing each of them requires you to realize that they operate according to different time frames. They operate according to different things. They're driven by different things. It's hard to have one news story shake the long-term trend, but one news story can shake the swing trend very easily, you see, and the trend can go down even though the long-term trend is up. Okay, so we've covered a lot here today. The market cycle model. The market moves according to cycles, and hopefully this has been very, very helpful to you.